It's a short-term blip. There's a lot of negativity on China right now, a lot of negativity on China. Investing isn't about the numbers. It's about the emotional side. I see it a lot, and I'm fine with that. That's a hard thing to do. Alibaba. This is a favorite of the Everything Money community. In the fourth quarter of 2022, I believe it was David Tepper and Michael Burry entered Alibaba. They liked something about it and they wanted to buy it. And Charlie Munger said it was his worst investment decision. And somebody I saw on Twitter today said, oh, Charlie Munger never took ownership of that investment mistake. I'm like, he literally said it was the worst decision. His reasoning was he thought it was more of a tech company than not. However, he didn't sell his shares. He once sold last year for a tax loss harvest. He didn't sell the remainder of his shares. And on top of that, the company just announced they're splitting the company into 6 divisions. I think 5 were tech related and 1 was retail related.
Yep, that's right.
So I don't know. This is part of the hard part about investing. You see a stock go from $310, $320 down to $58 at one point, and it's hard to sit there and keep a rational mind. That's what's hard about investing. Investing isn't about the numbers. It's about the emotional side. Can you see your stock go down 50% that you bought and be okay saying my thesis is still the same? So let's look at Alibaba. We'll take a look at it and go from there. Remember, don't own Alibaba because we do, but I do have an Alibaba position. I like it. I'm sticking with it. And okay, 52-week low is $58 on October 24th of this last year. 52-week high was just 3 months before then at 125. So guys, in a matter of 3 months, it fell by over half. This is the fluctuation in stock price. If you can't be okay with this, you should not own individual stocks. Just stick to ETFs. This is hard. It's hard for me. It's hard for everybody. All right, couple things. Low return on invested capital. And I think if we look at the numbers, we'll see why. 36% profit margin. So guys, as a comparison, this is considered the Amazon of China. Amazon's gross profit margin is 13%. What is gross profit margin? Gross profit margin is for every extra dollar they sell, how much do they make on that? And how much can they add to their bottom line? That's not a lot, right? That's not a lot at 13%. In fact, the 5-year profit margin bottom line for Baba is higher than Amazon's gross margin, okay? All right. Couple other things. Mo, what else stands out to you?
Let me see. I'm on the
Oh, you're on the income statement
now. Yeah, I'm just seeing their growth. I mean, it's been really great growth.
And then it's flat.
And then it's slowing down a lot. And I think that's a concern of a lot of people. Is it going to stop growing? I personally don't think it's going to stop growing.
It is in the largest market in the world with the fastest growing middle class in the world.
That's exactly right.
And they're expanding to other countries more and more. Listen, that's my thesis. My thesis is it's a short-term blip. There's a lot of negativity on China right now, a lot of negativity on China. I see it a lot, and I'm fine with that. Because I look at it going, do I think China will be more economically developed 20 years from now than today? And if they are, how will Alibaba do because of that?
Now look at the net income. That net income shot up in 2019 and 20 from 10 to 25 billion, and now it's right back down. Now it's at just under 5 billion.
Yeah, was there a write-off?
Let's see.
Look at the net interest income versus previous years. 9.25 billion loss versus 13.6. Right. You know what I mean?
Yeah.
Or is that an ad on it?
Let's see.
Nope. Oh yeah, that is an ad. So look at this, Mo. Look at what's interesting. Operating income by year. It's still going up a ton.
Yeah.
Their one big thing was a $9.25 billion net interest income negative versus positives in previous year. So understand that. Operating income, though, has been increasing and staying steady. So this could be a situation in which people look at the bottom line, not understanding above. Operating income is a pretty important factor for companies. How much are they making on their, how much money are they making from their operations? That's pretty important. Let's go check out their cash flow statement. Oh, one thing I want to point out. Look at the metrics page, Mo. Market cap, 267 billion. Enterprise value, 287. Yep. Guys, this difference means market cap is if you buy all the shares outstanding. Enterprise value is if you buy the entire company with no debt, net of all cash. There's only $20 billion in net debt on the company. That's pretty solid with 125 billion in revenue. Check out the cash flow statement. Now you have to go to annual for cash flow statements with Chinese companies in our software. The cash flow didn't drop as much as the net income.
No, it's back to basically
pre-COVID levels.
2019 levels.
Okay, so that's a pretty good indicator. Now remember, guys, if you like this, We haven't even gotten the stock analyzer tool yet. We haven't gotten to the analyst estimates, but our software here with all the tools available is only $7 for 7 days. Everythingmoney.com. You can check it out. It's $1 per day. It'll change the way you look at investing, and you'll get the community with thousands of like-minded investors you can talk to every single day. So if you want to change the way in which you look at money and be around like-minded people, because that is the hardest part. The hardest part is being on your own. Sign up, $7, 7 days, everythingmoney.com. Well, let's check out the analyst estimates. Now, remember, these analyst estimates are based on the currency, so just look at the percentage changes here. But look at the EPS growth over the next 7 years. It's almost, it's up 60, 70%.
Wow.
Okay, incredible. That's pretty solid. Let's look at revenue growth. High single digits, mid to high single digits revenue growth. I think that's being conservative. It's China. It's a fast-growing middle class.
Yeah, I don't think people factor that part in.
I don't know.
That's what I think.
I agree with you.
I think about them. India, Africa, not that I've looked at Indian or African investments, but it's the same kind of thing.
Yeah, India's going to be big growth potential too. Actually, probably more growth potential than China.
Yeah.
When you look at their per capita income. Right. And China had the first decrease in population for them for the last 60 years. India's still growing. I think India actually has more people than China does now. All right, let's go check out the stock analyzer tool. Let's go look at the 8 pillars first. Sorry. So guys, as you know, I have my custom 8 pillars here, and I have the regular EM pillars. I focus on the EM pillars. I was doing a screener the other day to try to find companies that fit these criteria. But look right here. Net income has fallen, as we saw. ROIC is down, as we saw. Shares outstanding is up slightly. So I feel like there are explanations for this. And this one I don't even know why they even issued 1% more shares.
Yeah. Don't they have a big buyback program going on right now?
They do have a big buyback program. That's right. So they bought back a few shares in the last few years, and they actually increased their buyback program.
Right. That's right.
Which I love seeing on companies that are undervalued, which this one very well could be. So that's when we go to the stock analyzer tool. I'm going to do a 20-year analysis. Mo's going to do 10 years. The goal of this tool is not including the balance sheet. What am I going to pay for the future cash flow of the business? This could be a wide range. It could be a short range. Remember, when I do a 20-year analysis, any small deviation in the revenue growth and profit margin will put a much bigger, wider range on the company. But that's okay. Now, the easier it is to define the future of the business, the closer your range will be. But don't be afraid of a wide range, because you have to make wide range assumptions on any company. So Mo's gonna do 10 years. His range will be probably narrower than mine, like we have in other videos, but just hang on tight. We're gonna fill these in on pause real quick. Hang on. All right, guys, so we each put our inputs in. Mine was 20 years again. Mo was 10 years. Mo, what'd you put for 10-year revenue growth rate?
So I went with 6, 9, and 12.
Okay, I did 4, 8, and 12. 12's a lot for 20 years. So if the company does 12% for 20 years and they did $125 billion, that takes them to $1.2 trillion in revenue in 20 years, though.
I almost went 6, 10, and 14. Almost. But I figured to keep it a little bit tighter than going outrageous.
Got it.
All right.
Profit margin.
14, 18, and 22.
So I did 10, 16, and 22. Okay. Because I just sat there and said, okay, let me put 10 in. I don't think 10's the right number. I think that's way too low. I'm really trying to be very conservative over here. Okay, what about free cash flow margin?
17, 21, and 25.
I don't blame you. I did 12, 18, and 24. And again, I think this 18 is a ridiculously low number.
Yeah.
All right, next one, PE and price of free cash flow.
Both are the same, 16, 17, 18.
I did 15, 16 and a half, 18. And your desired return, Mo?
10, 12, and 14.
Same with me.
I'm surprised they didn't go lower than 10 on the low end.
So guys, I want you to remember, I did super conservative here. I think this company will crush these numbers. So I could justify a lower return. I think this is actually plausible. I actually do believe this is plausible for a company like Alibaba. So, but I still put 14% return in here. Now, I hit the analyze button. I've got a low price of 80 to 95, a high price of 310 to 340, a middle price of 170 to 200. Mo.
I'm 129 to 157, 255 to 290, 186 to 220 in the middle.
And guys, remember,
it's a lot of green.
It's a lot of green. And remember that when companies look the best valued, the story has to be bad around it. And there's a lot of bad stories around Alibaba. If you can't handle those stories in the political environment we're in with China, you should not own this company. Only buy this company if you're okay with seeing the stock price fall in half from today. That's a hard thing to do. So thank you very much for your time, guys. Everythingmoney.com, $7, 7 days, $1 per day. You get all the software. Take care.